Let's bring in Sandy Villere. He's co-portfolio manager of the Villere Balanced Fund. Peter Boockvar is chief investment officer of Bleakley Advisory Group and a CNBC contributor. And our own Steve Liesman is here as well with a lot of moves just since that report was released. Steve, I'll just start with you because the headlines are pretty scary, right? It's the worst report in a decade. The export orders were the worst in a decade.
Yeah.
The employment index was basically at a four-year low. So if you were waiting for signs to be convinced that we're in a manufacturing recession, this is probably a pretty good sign of that.
Oh, yeah. No doubt about a manufacturing recession. We are in one, I think, pretty clearly. At least the data show that. The larger question becomes, are we in a broader recession? What we did is we went back and looked at the data, and what the data show is that not quite yet. You got to get down to 42, 43 on the ISM. Here's what we did. We went back and looked at how good a signal it provides. So 6 months before, you're at 53. 3 months before, you're at 52. The average now is 48. That's where we are right now. 1 month before is 44, and during a recession, you're at 43. So not quite there yet. It doesn't give you a great warning about an overall recession, but when it does hit that area, it tends to be lower than it is right now.
And Peter, we saw plenty of people saying, oh, we have to take this seriously for when this report behaves the way it does. But the only thing different is that this has been fully signaled. We knew the manufacturing slowdown was coming. We know why it's happening. The tariffs have hit this sector really, really hard. We've been hearing for months about how bad it is. So is it really telling us that the whole business cycle is ending when the consumer has held up really, really well as all this has been going on?
Well, the question was, to what degree are we weakening? Manufacturing topped out in August of last year. It's been steadily declining. But now we're in a contraction. Of the 18 industries surveyed, 15 reported a contraction. So we're now seeing it's not only are we in contraction, but the extent of it is more broader based.
Right. That said, would you take, so how do you invest around this? Do you say, I mean, look at bond yields today, right? We had just been talking about how high they were going because of what's happening in Japan and some other things. And then they came all the way back down. So what trades are you supposed to put on now? The world is ending trade, or the GDP is still growing at 1.5% trade?
Well, it's extraordinarily difficult because the safety trade, the defensive, the utilities, the consumer non-durables are very expensive. Expensive for good reason, because they're more invulnerable to the slowdown.
And everyone's been piling in.
Right. So I'm still focused more on value stuff that's already been beaten up, that's already cheap, that's already discounting a lot of bad news, and actually going to some of the markets overseas that have already been beaten up, that have had terrible 10-year runs, and that already reflect a much more dire economic situation. There's still a lot of hope in the U.S. that we will avoid that, but that's why stock prices are still very elevated, because people still think we're somehow going to skirt this and the manufacturing situation is going to be contained to that one particular area.
Right. Then, Sandy, so the interesting thing is watching the market reaction today. The major averages are down about 1%, which, again, I mean, we got a major bad data point. But if we're getting new information about the much higher odds of recession, you'd think we'd be down a lot more than this, right?
Yeah, I mean, really, we're looking at the Fed, we're looking at trade war, and then here we go with third quarter earnings. And third quarter earnings are supposed to be down about 4%. The trade war could end in more of a divorce type of negotiation than a marriage, unfortunately. We'll see how that all shakes out. But, yeah, with the lower manufacturing numbers, a 10-year low, that did increase the odds of a rate cut. And I think the Fed, that they're going to stay dovish and be supportive, is probably going to help the stock market over the long run. And so we want to buy high-quality growth stocks that maybe get beaten up in this environment and use the most volatile month of the year to buy stocks.
Okay, Steve, we also saw, the odds of a rate cut. So October had been about a 50-50 before this data hit. And we've been watching to see what's going to break this.
It was actually lower than that before the data. It was down to the 30s from what I saw, and then it popped up back again.
Because where are we now?
50,
about
60.
Maybe up above, above 60%.
It's back. I wonder, though, if Sandy sort of overstates the ability of the Fed to offset. I don't think that's 100%. I think that you still get into a situation, if the Fed cuts this time, maybe cuts again, where they cannot completely offset the economic weakness. All that said, our CNBC rapid update, we had a construction spending number today. We're still running 1.9 on the first quarter. On the third quarter, and we have 1.9 for the fourth quarter. So that is not, recession is not the odds-on bet. Weaker growth is, and whether or not we can escape. I look back, by the way, there's the Q3 on the construction spending today, down 0.1 to 1.9. We've been around 2 pretty much. So the question becomes, can we escape this? I look back at prior instances. You can do 2 months or 3 months of ISM manufacturing in contraction and the economy still go on.
Right.
It's what happened in 2015
again,
and 16.
I just wonder, and I should mention the Dow's now down about 300 points. It's a 1.1% drop. So is this different, Peter, because of the self-inflicted nature of it? I mean, there was always a chance maybe manufacturing wouldn't get hit hard, but it's pretty obvious that this was the sector most exposed to a political fight. Is that different from the business cycle ending, or does it just not matter?
Well, it's probably a combination. When you're in the 10th year or 11th year of a cycle, you're obviously late stage. So the question is what sort of tips it over? And no question that tariffs tipped it over. And the question is what happens now with the consumer. And a lot of that will depend on what are the hiring intentions now of these manufacturers. Well, it's clear that they are no longer hiring. They're cutting hours, and they're likely beginning to fire people the longer this goes on. And then it spills over into services, which we've already seen. We've seen a reduction in the ISM services index over the last couple of months. Mm-hmm. And does that start to impact hiring intentions?
The danger, Peter, though, is that the president, if he believes his own political rhetoric that this is all the fault of the Fed, will miss the proximate cause, which is trade and tariffs. And he continues to keep trade and tariffs up there, even while interest rates are way down compared to where they were a year ago.
He might get those rate cuts as a result of this.
He'll get the rate cuts, but if tariffs are the cause, then he's not going to fix that.
Sandy, just before we go, can you give us any specifics on those places in the market where you'd be right now?
Yeah, I like a couple of healthcare names, high-quality growth stocks. I like Abiomed, ABMD. I think they've got a phenomenal product in the Impella device, a temporary heart pump. And then I like another company called Teleflex, TFX. I think they're going to do quite well with a product called Urolift that's been growing 19% year over year in the interventional urology area. So two good high-quality growth stocks.
What's everyone worried about? We got heart pumps and urology. Okay, there's, whether we grow 1.5%.
Doesn't matter. It's all about stock picking at the end of the day.
There you go. Thank you, guys. Appreciate it all very much. Sandy
Thanks,
Villere, Peter Boockvar, and Steve Liesman.